It's interesting. We started as seed, and today we call ourselves like it's a full stack from seed to like pre-AA, right? Because that, there are lots of segments within that. There's seed, angel, pre-A, and A. So I'd say that we are, everything from seed to like a pre-A/A.
Okay. Why did you choose that particular segment?
Right. When Karthik and I started Blume, Series A was very prevalent, right? If you look at that, if you looked at it visually, you had about 10 or 12. You had about 10 or 12 Valley VCs mainly, right? Some of them also shut shop and left, like KNN and DFJ. But they were all typically not cutting checks of less than, like, say, 2 million. So Sasha, Mumbai Angels, Rehan. There were a couple of angel groups, but the angel groups became much larger, and we thought there's an interesting opportunity for like an angel fund or like a super angel fund that will behave like angels, like an angel, but still be institutional. So that looks at investments of less than, let's say $1 million. That's the space that we chose. Today that's today we've got accelerators and you've got incubators, and it's become very rich and vibrant. But that's when we started. We saw that was a big gap.
So how have you seen, how has it worked out for you? So maybe talk a bit more about how many funds you raised and how you're doing, and then we can talk about the ecosystem. So firstly.
So it's interesting, right? I mean, you hear exits traditionally have always been few and far between. Private equity has also been a mixed record. The top private equity, the top decile has performed well, but in general, private equity and real estate has sort of been, like average. So exits are happening. I mean, for us, from our first fund, we had Twitter's first acquisition in India, which was ZipDial. We had PromptTech get acquired by Havells, and then we had Taxi for Sure that was acquired by Ola Cabs. Where it was a mix of cash and stock. So those were important because that's how you raise your your second fund. Fund 2, if you look at Fund 2, the quality of founders and of course, quality of founders in Fund 1 like Grey Orange and all was also fantastic. But the general pool of the founders has become a little more mature, right? You've seen people who have learned from their mistakes, starting for the second time. They've seen what some of the bosses in larger companies have done well, have not done well. Sometimes raise too much money, sometimes not raise money. So in general, we're finding that Fund 2, the cohort, is moving a little faster, right? They've raised larger rounds, but the cohort is. So I think of it as like, if you think of it, I'll talk about the Bay Area, for example. There are these two freeways, right? There's one freeway which is always chock-a-block of traffic. The second one moves faster. So I think Fund 2 in general has been where a little more mature founders and they're moving much faster from A to B. And a couple of exits happened. We got Nutanix acquire our Minjar or Botmetric. We had Zomato that acquired Runner, right? So we're also seeing some early exits from Fund 2. And now we're on the road for our Fund 3. So exits, of course, we're very, very focused on exits. But what's interesting is there's lots of new pools of capital that are coming in, from China and Japan, for example, which were not on the not on the radar like about 5 or 10 years ago.
Let's talk about that. So you've raised money from domestic as well as institutional foreign players. How do you see the difference between the two in terms of how they sort of do due diligence on you and how they invest, basically?
So I think any homegrown fund today that's starting up can't ignore domestic capital. It's here to stay, and it's very welcome for the ecosystem. I was just sharing on the panel that, let's say, there's been a sea change about 10 or 15 years ago when Nexus and Axel and all started. It's very true that foreign investors had more confidence in India than we had, or rather Indian LPs had. That's been a big change. I think Indian investors in general tend to be a little more financial oriented. So, for example, they're going to look at they're going to be long-term investors, but they're also going to look at what is this IRR going to get me relative to private equity, relative to a direct investment, relative to, let's say, real estate. I think the foreign investors in general have looked always at venture capital as a separate asset class. So they understand the risk. They're very long-term players. When they come in, they're actually backing you for multiple funds. But the sales cycle is, of course, longer, right? Because increasingly many of them are coming to India now, right? They have their own road shows. They come and attend AGMs, and that's when a lot of these groups have been meeting us. The Chinese and Japanese is interesting to talk about, or even Singapore in Southeast Asia, which was earlier, if you talked about going global for fund managers or for companies, it meant going to the West, to London or New York or San Francisco. The number of our founders today that have Beijing, Shenzhen and Tokyo and Singapore on their passports has just skyrocketed, because right from the Chinese BAT to new funds like Morningside, CDH, Shunway Capital, to the Temasek, the Vertex, and B Capital, right? Blume Ventures in Singapore. And then in Japan, I mean, tomorrow there's an investor conference in Japan that in Bangalore that I'm heading to, which is basically hosting Japanese investors. Are very, very interested in India. Japan is a very aging population. India's youth, young talent, and they're basically seeing this as a massive talent pool that they want to tap into. So this is very welcome for the ecosystem, which was, I think, the Chinese, the Japanese, and Southeast Asians were not on the radar screen. It's great for Indian founders.
Sorry, are they investing in individual companies or in funds like yours?
So they're doing both. I think the dynamic of the LPGP is changing. The Western sort of endowments, right? They're typically just LPs, and sometimes they'll co-invest. But if you look at the Japanese, and not SoftBank is an anomaly. But you look at the others, they're actually investing into funds. Then they're co-investing with you, and so they're doing a mix of both. They get the diversification from a fund. But then obviously based on the strategic interests, they may like certain sectors, like some of them like only B2B deep tech. We just did an alliance, right, with the University of Tokyo Edge Capital, UTech. They only do deep tech, AI, healthcare tech, whereas some other Japanese investors like Akatsuki that just launched a fund, they look at content, gaming, entertainment. So different strokes, for different folks, but they're here to stay, and I mean, you see tons of them, right? Even at this event, I've seen.
Yeah. And so, and co-investing is here to stay as well, and you don't mind that, the fact that you do your due diligence and yet they get a free ride.
Yeah, well, it's interesting. How free ride is defined. I think if it is, so I think there are three kinds of capital, right? There is smart capital, there's good capital, there is, let's say, a neutral capital, you could call it like dumb capital, and then the third area is what I'll say, for lack of a better word, I'll call nuisance capital, right? As long as it's not, so what harmful or nuisance capital is that when somebody gives you the money and feels, I've given you the money, I can tell you how to run the business. As long as something is neutral capital, it's fine. So when you coming back to the free ride, I think it's good leverage. Some of these investors come in, they might come in a small amount, but then they will invite the founders to a panel to Tokyo, where if somebody's invested 200,000, they'll actually go and get 2 million from their network. And it's great leverage. They're getting to be on an international stage. They get in front of Japanese corporates. It's very interesting. It's no Indian corporate would be able to give that. So it's like the cap table is like a puzzle, right? That you have different puzzle pieces. You're not just getting one.
Let's turn back to your own fund.
Yeah.
I've heard Karthik describe your investment philosophy. So can you just summarize that
Sure.
as a pitch to whoever might watch
Sure.
this?
So what we want to, I think we're positioning ourselves, and I think we're coming to be known as that first port of call, when the first institutional fund where you're post angel, when you're looking for a partner, we use the word FPG, right? Friend, philosopher, guide. A lot of our founders, a lot of our LPs like Blume because they feel we've picked very differently. So if you look at B2B, look at Grey Orange, Carbon Clean Solutions. We backed these when many funds were mainly backing consumer, right? Only the Olas, the FinTech, and
So was B2B
companies.
part of your philosophy?
B2B is because if you look at B2B, it's basically the next wave of outsourced services, right? Typically, if you look at Infosys or Wipro, they're all services companies. You had brilliant engineers, but nobody was building products. If you look at InMobi today or Grey Orange, they're brilliant engineers who are actually building product. Today, you have a company like Locus that is getting PhDs from Carnegie Mellon, coming back, doing data science, doing AI, right? So B2B is very interesting. Also, look at exits. B2B is much more likely to get interest from, in one sense, from a Google or from a Intel, and you don't have to necessarily wait 10 to 12 years for that. Now you're not going to have, it's not as likely that you're going to create a $10 billion or $15 billion Flipkart in B2B, but you're actually going to churn, get exits faster, but also build substantial businesses. So that's one that we always pick differently. And the other is, I think, relative to larger VCs that sometimes might come with a view. So for example, the larger VCs might also have operations in China or in the Valley. And if something's worked there, they may say that, hey, what's learning can also become baggage, because that worked in China, they become unicorns to do the same thing in India. Versus, I think we are a little less prescriptive. We'll work with the founders, be very founder friendly, give our views but not necessarily impose, right? And I think that founder friendly culture is very important to attract those type of founders.
A lot of the VCs I've interviewed say that it's not just the money that they're giving, they're also sort of doing all the hand-holding and stuff. Is that sort of, I find that almost a common statement from everyone. Is that something that you do? And
yeah, so I know you were, you visited a complex some time back, but we have got to do a formal interview. So somebody was asking me the opposite question, that how do you manage your fees? Like, how do you survive? If you look at this AUM to platform ratio, I think we are one of the highest. So I'll explain. If you look at Andreessen Horowitz, they have a corporate center next to their VC arm, and what they do is, I think they do something like 1,000 engagements a year, but they have 40 million of fees that they're sitting on, right? That's larger than most, first-time funds. We have built a platform where the investment team is about 10 people today, and then we have a platform called Constellation, which is in more than 40 people. So what this is basically designing the founder at the center and saying, if the founder is your customer, what are you doing for them? What are you doing for him or her? Sanam and a team, we have 7 people that just do full-time recruiting and hiring for our founders. Only for our founders. Ashish, who you know, we have, so we call it back office, but it's basically finance and accounting. It's shared services, value-added shared services, term sheets, working with Singapore lawyers to move, let's say, work on the IP there, Delaware incorporations, corporate due diligence, legal. Then we have marketing. We have we also helping them with preparing pitch decks, so investment banking, business development, because the real work starts after you've cut the check, and there's so much time that can be lost, like GST, demonetization, angel tax. How do you? So I used to be at IBM after PwC, and I remember their line when they came up with that whole on-demand was, "We'll do your mess for less." Right? So not necessarily saying that that this is a mess, but the fact is you want your founder to focus on sales and focus on the product, right? You don't want them to get distracted with everything else. So the platform really comes in.
Do you have any views on, are you happy with the way the angel tax issue has been resolved?
Well, I think none of us are happy with what happened, but I think we're happy with the steps that are being taken. I mean, just today as you were just flying, and we saw that that now the limit has gone from 25 crores to 100 crores, 7 years has gone to 10 years, and then they're relaxing that, and our hope is eventually they do away with it. I mean, if you look at Singapore, for example, right, not only do we need to take the negative instances out, we need to spur incentives, whether they're grants, whether it is other incentives to incubators, these tinkering labs. So I think they're making the right moves. They're doing it a little slowly, but they're announcing it, and it's making news, which is important.
So the question that I guess comes to mind is, why is everything so slow in India? As you know, I was Mercer. We came, we saw, we left because it was too slow. What would you say to an overseas investor, or for that matter to your own government, on how to accelerate the pace of some of these reforms?
And see, by the way, I mean, the market is so large. The reason the Japanese are so interested is they're saying that we have one of the youngest populations, right? Bain did a very interesting study recently where they basically said, we've gone from the pyramid, bottom of the pyramid. Actually, it was like an Eiffel Tower with a very broad base, then which went to a bottom of the pyramid, to now like a middle of the diamond, where 7% is going to be at the top and 14% is going to be at the bottom, and then middle class is going to be 500-600 million people, or let's say 300-400. So the option is massive, right? Now we're talking about speed. I think also we've got to think about not where we can be, but also where we were, right? I mean, it's like we're like a super tanker. You're trying to move a super tanker like a speedboat. So I think we're making the right moves. The IVCA is doing a great job by having senior VCs, PE managers involved with heads of government. Sri Ramesh Abhishek was at the annual IVCA summit in Goa, where Karthik moderated the panel, and we were talking about the changes. So I think they get the problem, and they know what has to be. It's just a question of implementing it. So I think the advice to overseas investors is to be patient. Now we're seeing signs of that patient coming off, right? I mean, we had the Flipkart exit. We're seeing exits happen. Naspers, we're seeing them exit from companies but coming in again. So there are a lot of strategics coming in. And the Chinese and Japanese are here to stay. SoftBank again has hired somebody now for India, right? so many joined them from Norwest, and those are good signs, right? I mean, that means that India is a really strategic market here.
So you're obviously optimistic, right?
I think absolutely. I think I think government reforms, as far as this is concerned, where you basically make it either don't get make it even easier, right? Have more incentives, and the second is I think we collectively need to just get up the pace of exits.
But exits to whom? So, I mean, the cynical view would be that the founders have become, everyone I see, they see fundraising as a sign of success. It's no longer whether you make money or not. It's, I raised so much money. Then they make it to the 40 under 40 list. And then they basically sell it to somebody else. I mean, they build businesses just to sell. Yeah. Is that really a long-term?
So, I mean, let's do it. I think the media also did a great job by, in a sense, like creating page 6 of the Economic Times. Right? Many people look at that. It's like the page 3 of a Bombay Times, but for the startup ecosystem, right? So it's never been more interesting and exciting to be an entrepreneur, and also today apparently to be a fund manager, right? But the flip side of that is also, lists are just lists, right? What are you really building? Like, we have sophisticated investors asking us questions that, okay, what are the revenues of this company? What is the path to profitability, right? Versus how much they've raised and how much are they valued at. So I think the right founders get it. In a business like Ola, you have to raise because your competition is over. But if you look at B2B businesses, for example, they can become profitable. They're building real products. Look at like Tricor, Grey Orange, they're building products. So yeah, there is a lot of hype, which is why everybody wants to become an entrepreneur. But I think the last 2 years we had a period of rationalization, which was good. You had a lot of, like, look at food tech, right? There were 50 startups, 45 of them burned, which is good for the ecosystem, which means that fat has been cut. Today, people are really, you have to really be serious before you want to start a business. There's no free money. There is money, we're raising a larger fund, but there's no free money. It's for the best entrepreneurs.
I see a lot of fat in FinTech. There's like 130 robo-advice platforms from what I can see.
But again, see, you're
different segments.
You're
So maybe
right.
it's going from one segment to the other. But
so if you look at that incubator accelerator, early stage capital today, your family offices, you have angels. There's lots of capital early. But you're right. Not all of them are going to make it. There's going to be a lot of consolidation. If you look at Book My Shows, I mean, they've become a behemoth, right? So you may have a lot of people that get into it, but not everybody will make it through. And we are taking our time, by the way, to invest. Like I think a couple of years ago, when the market was maybe a little more frothy, even then we didn't rush in. Today we have a pre-IC process, we have an IC process, we have a larger team. We're not rushing. I think generally investors are taking more of a measured approach, and being more careful.
Yeah. So which segments do you focus on? They're the entrepreneurs that will watch this video and pitch to you.
Well, in one sense, I forget which senior VC said it, but it's not like we're not like in the fashion business where the fashion lines change every season. We look at India as two Indias. There's a consumption side, and then there is the built in India for global market side, right? On the consumption side, I think a couple of new themes. We're seeing like content commerce. So we've got Little Black Book, for example. Little Black Book is basically, so you're very, very powerful on the content side, and then because of that, brands and the others also come to you because you have an engaged audience. So content commerce, local content, you're seeing a lot of it. The Chinese are coming into that. Agritech is very interesting. Agritech, we've not done anything, and we're looking at a couple of companies now because there's data, there's mobile phones. The farmers, you can empower them. Healthcare, for example, Fund 1, we didn't do anything. We've got Tricog, which is virtual cardiologist. We have Healthify Me, which is the mobile app.
This is what you have. So, but these are the sectors.
And I think Agritech is very new. Agritech, I think we had not looked at in fund 3 at all. So Agritech is new. I think content commerce is interesting, and I think deeper tech. Earlier B2B was mainly SaaS enterprise. And I think now we're going to get into data science, AI. Well, AI is very, very broad, but what I mean is robotics. I think space tech is very capital intensive, but I think we'll see much more interest in deep tech, data science, more differentiated tech than just software and services.
No real estate or anything like that. It's more.
Well, we don't do that, but I will say that consumer brands. Look at Epigama yogurt or Bira, right? I think the Indian consumer wants to be different and wants to have something different. So we may not be investor, but we're a consumer.
Right.
Yeah. Okay. I mean, it's a new India.
Yeah. Any last words of encouragement or feedback to IVCA?
Well, I think the fact that they put this forum together is very interesting. The fact that it's in Delhi and we had government officials who are part and parcel of it versus being bystanders either way. I think that's really interesting. To do more of it, and I think just to spur innovation. So just keep doing more of the same, and glad to be here. And yes.